Welcome everybody. Thanks for joining us here at Free Game University. Today we're going to be talking about some of the basics of a mortgage. What's in it? What's it consist of? But before we go ahead and get into it, if you could do us a quick favor and hit that subscribe button right here in the bottom right hand corner of the video, it'd be much appreciated. Thank you. Alrighty, so let's review some of the major components of a mortgage. Then we'll look into each segment with greater detail as we continue on throughout the video. Now there are 4 different major components that aren't going to move a muscle. They'll even stick around to meet your grandkids if you aren't careful. And those 4 components include principal, interest, insurances, and taxes. Now there's one last component that may sneak up on you, and it's something to consider before purchasing a new home. And we'll talk about these in detail as well. Now let's take one sidestep for a second and talk about something called the amortization schedule. What this is a formula made to calculate your monthly payments on your principal and your interest. What they want to do is make sure that it remains constant throughout the life of your loan. Now, I'm going to be honest with you. They made this complex formula right here not only to keep your payments constant, but to ensure a majority of your payments are going towards interest first, or in other words, the abyss, aka towards their bills. And you'll see just how in a second. Everybody wants a piece of the pie. Everybody wants to be in your wallet. Now let's discuss principal. What the principal is any payment going towards the house itself. So in our scenario today, we're going to assume that the house was purchased at an even 100 grand, right? And we'll assume a very common occurrence that the length of the loan is 30 years and the interest rate on the mortgage is 4%. When we put those numbers into our wealth snatching formula, the amortization schedule, we'll find that our first payment going towards the principal, actually paying off the house, would only total $144.09. So if you follow along the bottom here, you'll see the grand total is $144.09 for this year. However, we still have 3 more components to account for. And the next one will break your poor little heart, I tell you. That component is interest. Interest rate is determined by your financial status. They have something called a DTI, debt to income ratio, which we'll discuss in more detail in another video. But what it factors in is things like credit score and cash on hand. And when you use those same numbers, 100 grand for the house, 30-year loan, 4% interest rate, we'll find that in the first month's mortgage, a whopping $333.33 of your mortgage payment will be getting thrown into the abyss, thanks to their evil calculation. So here we have at the bottom of the screen, you can see there's now a total of $477.42 for both the principal and the interest. Now that $477 right there will remain constant and very slowly over the next 30 years. Each monthly payment will gradually pay more towards the principal and less towards the interest. But now you can see why I call it the abyss. But hold on, there's still 2 more components to this mortgage payment, so hold on tight. The next component is insurance. Your homeowner's insurance, to be exact. Now this component is quite simple. the mortgage company has what's called an escrow account to pay bills on your behalf. You pay one mortgage and they do all the legwork. One of those bills being paid out of the escrow account is your homeowner's insurance. So, if your homeowner's insurance premium is $1,200 a year, you would just divide that by 12 and you would have a monthly payment of $100 a month, bringing our current mortgage total to $577.42. And as we said before, these two numbers right here will always total the same amount, no matter how much is going towards the principal and how much is going towards the interest. And they find that by the amortization schedule. The next component of your mortgage is taxes. Believe it or not, Uncle Sam wants a piece of your pie too. Thought he was a family man, but I suppose he's a businessman as well. Now, let's say Uncle Sammy here charges you $2,400 a year to own this piece of property. Well, you divide that by 12 months, and congratulations, you've earned yourself an extra $200 a month on your mortgage. That brings your total mortgage to $777.42 per month. Thanks, Uncle Sam. That's just what we needed. But wait, there's more. There's other expenses that could easily raise our mortgage, such as warranty, homeowners association fees, condo fees, disaster insurance, mortgage insurance, and maintenance. And maintenance is very important. Some items on this list here, you may want to have. It may be put to pretty good use. Other items on the list, you may want to avoid. End of the day, you want your mortgage payment to be as cheap as possible. And we'll be covering how to lower your mortgage payments in a video here in the near future. But until then, if you haven't already, go ahead and subscribe to our channel so you know when we'll release the latest and greatest. Until next time, this is Free Game University, a one-stop shop, valuable information, 100% free. Thanks for watching.